Well, welcome back to the hot seat. I'm delighted to be joined today by Jamie Berry, who's Executive Chairman of Bourdieu UK. Welcome, Jamie.
David, thank you very much, and thank you for having me.
Pleasure. So, you're an experienced investor. You formed Berry Asset Management back in 1981 with a different approach, managing funds rather than direct stocks, which was different at the time to the norm. Perhaps you could explain us a little bit more about your approach and what made it different.
Yes, of course. My background was institutional fund management. That's really where I cut my teeth at the beginning of my career. And I worked in a fund-based group, and we ran a unit trust business, which I was in charge of. And I saw, therefore, I think probably funds in a more positive light than many people. And the unit trust industry then was in its very early stages. It was dominated by only really a handful of small groups. You have to remember that the private client wealth management industry was very different then. The DFM space, as we would recognise it now, didn't really exist. Private clients were looked after almost exclusively by private client stockbrokers. Private client stockbrokers dominated their portfolios with a mixture of direct UK equities, which would be household name type stuff. And if they wanted to invest abroad, they'd probably have a couple of global investment trusts. And I didn't think that was the right way to go about managing wealth for private individuals. And it was really on that basis that I set up the business, which in those days would have been called Unit Trust Portfolio Management, but it then broadened out into really what we would now call multi-asset management. And of course the DFM space has grown hugely over the following 40 years or so.
And you sold the business to Bourdieu in 2001. How did that deal come about? What was it attractive about it for you?
I sold it in two or three different stages. In about 2000, it became very clear to me that it was a really pivotal point for my business. And it was the right moment to try to seek an outside partner, probably only looking for a minority stake. While we were doing that, we were actually approached by another corporate finance business who were acting for a Swiss bank, which turned out to be Bourdieu, and they were looking to make their first footsteps outside of Switzerland, the first footsteps in 150 years or so. And I met Gregoire Bourdieu, who is still my partner, and we got on extremely well, and they acquired a minority stake in 2001. We fast forward a little bit to 2007, when they became a controlling stakeholder in the business, and in 2014, we dropped my name over the door and became fully Bourdieu in the UK.
Okay, and I know the Bourdieu Group well from my travels to Switzerland and business I've done there over the years. But perhaps for those less familiar with the group, perhaps you could explain a little bit more broadly about its operations internationally.
Bourdieu is an exceptional business, and it's a very unusual business, I think, nowadays. We are looking at the fifth generation of a dynastic family, still run by members of the Bourdieu family, with unlimited liability in Geneva, that has now branched out not just with us in the United Kingdom, but with offices in Singapore, where we have a full banking license, in Turks and Caicos, in Paris, and in Latin America. And I think it's still seen very much as a family business, only concentrating, like a lot of the other Swiss banks that you mentioned, that have broadened out into really becoming full-blown institutional fund management houses. That is not what the Bourdieu ethos has been about. We only really look after private clients across the world.
And do you see that the fact the ownership structure being different removes conflict that might exist in other businesses? It creates more alignment between clients and the bank's owners. I think,
David, I think it's absolutely crucial. The private client wealth management landscape is probably one of the most overcrowded sectors in the financial services industry. And it's very, very difficult, I think, for private individuals to differentiate. And I think our absolutely key differentiator, one of them is that we only look after private clients, but that on its own is not sufficiently different. I think the key difference is all about the ownership structure of the business. When you look at most private client businesses of any scale in the United Kingdom, they are either part of a much, much larger group, or they're listed publicly quoted businesses themselves, or they have private equity backing. And those are probably not particularly good bedfellows with long-term private client portfolio management. Sometimes it can be, but not always. We have effectively, rather like private clients, we have an indefinite time horizon, and therefore I think it creates this true alignment with clients. There's no products to sell, there's no targets to be met, and our view is that if you focus every single thing on your clients, in due course we will be adequately rewarded, but there's no great rush. And if you're a business that's been going for over 170 years, you're not in any big rush. And I think that's a true alignment with clients. And what I find is when you explain this to clients, you can almost hear the penny dropping with them, thinking, actually, that's precisely what I'm looking for.
And international clients often carry with them some complexity around the tax position. They want to invest through different vehicles, trusts, and look at other considerations. I mean, do you cater for that in-house, the broader sort of wealth planning?
We do some broader wealth planning in-house, but very much we work alongside other professional advisors. I mean, in London, the bit of the business that I'm involved with, we've been working alongside other professional advisors of all different types for over 40 years now. And it might be highly specialist tax advice, it might be highly specialist financing for things like yachts and planes, it might be legal advice, there's all sorts of different things, and we will work alongside other existing advisors of a client, or if they don't know anybody, then we have a pretty broad network of people to whom we can introduce them to. I think one point I'd make is that some of what I say there slightly implies that we might often be the so-called trusted advisor right at the core of a client's affairs. Sometimes that's the case, but I would say generally we're not the core trusted advisor. That will tend to be either their IFA or their lawyer or their accountant, and then we're one of the spokes, if you like, on the wheel.
A strong part of the team.
I hope so.
And I suppose part of that story is having longevity of service internally with your staff. I mean, many of the senior management have been in the business a long time with Bourdieu. Do you think that kind of continuity is important in an environment where private bankers might move around between different shops? You know, the fact that you've got some continuity amongst the senior team creates value for clients.
I think it's absolutely crucial, David. I mean, the letter that we all dread getting is from our bank saying, we're delighted to tell you that the person who looks after you has been promoted to head office, and they're no longer going to be dealing with you, and you've got to get to know some new person, and your heart sinks. And we try very hard that we never have to write those sort of letters. I think we make our sort of secret of our success, if I can call it that, is I think we make the firm a very nice place to work and a caring place. We give the team, where it's appropriate, a lot of autonomy. We can offer career progression for people. But I think really at the very heart of it, it's all about culture, and it's a people business, and it's a family business. I mean, Grégoire Bourdieu, who is effectively the managing partner of the group, when he comes to London, which is pretty often, I mean, not only does he know everybody in the office, but he wanders around saying hello to everybody. And that's quite unusual. That's not something that you would generally expect. And I think it's that tight-knit feeling that is absolutely crucial. And for clients, it's what they want, because they do want to identify with, say, it might be several people, it won't just be one person, because we offer, every client will have not just one lead manager, but we'll also have what we call a shadow manager, and then they'll be backed up by a client support team. And so they'll know a lot of individual people by name, and we will know the clients by name. This is not a business where we're referring to clients by numbers and things like that. And in fact, if a client quoted their reference number, we'd be probably completely flummoxed, because we wouldn't have a clue who they were talking about.
And that relationship's incredibly important, isn't it? Today, we're in choppy economic waters at the moment. The relationship you have with someone creates trust, doesn't it, and credibility. I mean, perhaps you could give us a sense, just turning to some of the investment themes and the ways clients are allocating assets at the moment. What's your view on how clients should be invested to navigate these choppy waters? I think
it's a very challenging time. I mean, that's become a truism. I can't really remember a time when we said it wasn't, when it wasn't challenging. We've got obviously inflation, we've got the dreadful conflict going on in Eastern Europe, and we have effectively a seismic change in the direction of interest rates, which is probably now having enjoyed a decade or more of sort of easy money, that's clearly about to change. I think what we're saying to clients is they must focus on their original long-term goals and be absolutely certain that they're comfortable with the level of risk that they've got adopted in a portfolio. When we help them navigate all of these things, and then you really have to focus on those long-term aims and aspirations and not change things. I mean, for us, we're still within each individual risk mandate fully committed to equity markets, and we think that with inflation there's going to be a spike in inflation, but I think most people think that although it may be a little stickier than people were expecting a few months ago, I think most people do expect that by the end of this year and next year, inflation will get back down to a more manageable level, which is a manageable level for equities to be a very good store of value. So we're telling our clients to focus on that longer term picture, leave the day-to-day job to us, and not to worry unduly. I don't think it's going to be an easy period for people, but we're still confident that we can deliver the returns that we set out to do at the beginning.
And is it the time for selection of active asset managers, you know, where
Very
we've been
much
in
so.
an era of where passive managers actually...
I think very much so. I mean, there's been a lot of people like to say, just put your money in a few passive funds and then go off and enjoy the sunshine. I think that we are now most definitely in an era where active management is absolutely key. And what I think we find in the fund manager interviews that we do, and we're doing an enormous number of these, not just in the UK, but around the world, a common theme, and it doesn't matter whether it's a UK equity manager or US or somewhere in Europe or Southeast Asia, all of them are saying that they've never had it so good in terms of specific stock selection. And they're saying this is our moment to shine, because it's so much clearer than it has been at other times of basically rewarding specific stock pickers, which is not always the case, but it seems to be at the moment.
And how do you see the ESG and sustainable investment themes kind of being incorporated into portfolios? What kind of demand do you see from clients in this area?
We're getting more and more people talking about ESG, and it's becoming, I mean, I would say particularly with charities and with professional trustees, it's centre stage in terms of their discussion. I think with clients it's still evolving, but it's going to become a more and more important part of the investment landscape.
Is there a lot of greenwashing out there, do you think?
Yes.
Or,
Yes. And I think it's also, I think the situation in Europe has shown that actually ESG is more complicated than people thought. So it's not just all about green issues. There's actually much more to it than that now.
There's also strong demand at the moment from family offices, particularly in private markets, private equity deals. How do you work with clients at Bourdieu around other asset classes within the asset?
We have got in Geneva a link up with a platform for private equity, and that's doing a number of different things. First of all, it's making the actual menu of availability much broader than it was before. It's making, if I can call them, the sort of barriers to entry much easier, whether it's in terms of the paperwork, but also the minimum sums of investment. So we're very much on the ball with private equity, whether it's not just for family offices, it might be for higher value clients that are wanting to have some element of their portfolio in private equity, and we can facilitate that very easily out of Geneva. Okay.
And I mean, do you find that the Swiss investment management approach is different and gives you another angle on top of the UK kind of expertise? And when I've worked within Swiss institutions, I've seen them operate and think about markets in different ways. Do you think that brings something extra, different perspective perhaps for clients?
I think it's a great question. Yes, is the short answer. I mean, the Swiss, historically, for a very long time, have always been more conservative, probably, than other investors, and it's served them very well, whether it's as a nation, and you look at the behaviour of the Swiss franc over long periods of time, and also Swiss investors. I think that the business that I set up and ran, as it happened, was also quite conservative and prudent in nature, although the Swiss would probably say, no, we were more aggressive. But in comparing ourselves to our peers in the UK, we were generally, and I think possibly still are, seen as a relatively conservative and prudent manager. And I think that one of the reasons for that is we've always been much more concerned about not losing money for people than try to sort of full participation in the upside. Because the one thing that, well, I've learnt lots of things in private clients over the years, but one of the things that is actually sort of stamped across me is that private clients do not, well, nobody does, but private clients do not like losing money. And therefore, we have learnt from the Swiss about wealth preservation being absolutely key. Because if you can't preserve wealth at the beginning, then you're not going to still be there to participate in wealth creation in the good times.
And I mean, new asset classes are coming out all the time with crypto and different innovations, and people then searching for alternatives as well. The two things are converging. I mean, how do you see crypto assets? Is it going to be the new gold? What's your view on that? As a store of value?
Yes, I mean, I think there's a lot of problems with crypto. I mean, there's obviously vast numbers of individuals. We've all heard of 2 or 3 of them, but in fact, there are several thousand different types of cryptocurrencies. I'm sure you're aware. Through Geneva, we have the capability to not only trade some of the major cryptocurrencies for people if they want to, but we can also hold them in wallet in Geneva. So we know the ropes and we know how to do it. My own personal view about crypto and our view really in London is, I mean, if clients want to do it, we can effectively facilitate the arrangement. I think the big issue with crypto is there is no intrinsic value. You're just looking for somebody else who's prepared to pay more than you were at the time of sale. And that I think is a fundamental problem. For me, another fundamental problem is that I think that central banks will move mountains to try and keep the lid on cryptocurrencies. Because if the genie is out of the bottle with cryptocurrencies, then collection of tax at a sovereign level becomes incredibly difficult, and central banks effectively lose control of money around the world. And I think that they will do their utmost. Whether they'll succeed or not, I really don't know, because this is it's a difficult, possibly King Canute type thing that they've got on their hands. But I think over the next few years they will do their best. And if you look at them, even just in the last few weeks, the extraordinary volatility of something like Bitcoin, it's a very, very speculative market. But if clients want to do it, we're there to help them.
As you mentioned before, we're in a period of uncertainty and volatility at the moment. That's not unique. In the last 40 years in your investment career, you've seen many periods of volatility. What do you think the key messages are for clients right now seeking some reassurance, seeking some guidance on how they invest their money?
I started my career in the city in 1973 when, I mean, people talk about bear markets now, but the bear market which was unfolding as I joined was very, very savage. We saw a 75% drop in the value of the London stock market. So the type of bear markets we see now have been a very pale shade of that. In London, we've had 40 years worth of experience. In Geneva, they've had 177 years worth of experience. I think they think we're in short trousers, really, in the experience stakes. But we've seen an awful lot. And I think people, as I said a little bit earlier, they have to focus on those longer term goals and not be distracted by a lot of what you might call the sort of white noise and volatility. Volatility is going to be with us as a characteristic of investment probably forever. I mean, the availability of information is just so sudden and everybody gets it at the same time. And that didn't used to happen. And also there were pockets of wrong information or just lack of information. That doesn't happen so much now. So markets tend to go all the way in one direction, all the way in another direction. I think the secret of success is to ignore all of that and not to listen to the sort of siren voices, whether they're in the press or other pundits of saying, "Well, do this or do that," but actually, no, stick to your last.
Great. Well, look, terrific to talk to you, Jamie, and really look forward to sharing this discussion with our members.
Well, thank you, David, for having me.